All right. Hey, everybody. Good morning. Thanks for calling in live. And as always, if you have questions, text me or use the chat function, and I'll do my best to get them read and get them answered. Um, Obviously, lots and lots going on. So as we jump in, what we want to do when the adrenaline's flowing and the markets are going crazy, we kind of want to do everything we can to be as objective as we can and to kind of simplify things as to what's happening. So what we've got up on the screen right now is the crop report from yesterday. That was the big mover in the January crop report, and there were lots of changes in this report, particularly as it relates to corn. And I'm not going to dive into every one of those changes. I mean, they decreased demand by lowering ethanol, by lowering exports. Somehow they decreased yield. Um, the hardest thing to do is make sense of what the USDA is doing here. And I think there's going to be lots of guys that really just overanalyze what the USDA did. So I'm going to just make it really, really simple. This number right here, which is the ending stocks number, this is your December report, this is your January report. The ending number is in a downtrend, and it has been for many reports in a row. So I think that's the takeaway. The USDA is adjusting numbers, and I think they're guessing on lots of the numbers that they're trying to put out there. I don't think they've got great data. I don't know what's going on there, but bottom line is that the ending stocks number is trending tighter, both in corn and in beans. And I think that the corn market has been kind of just holding back, waiting to see whether or not um, it needed to really go buy acres. And so as we look at what's going to come forward, we have to remind ourselves that when the balance sheet is getting tighter, it's going to stay that way until we either ration demand and slow it down, or we generate new supply that's in excess of expectations. So what could those be? Well, clearly we could get so high, nobody can afford to buy anything, and we just shut off buying, right? I mean, clearly we can ration demand through higher prices. South America could beat crop expectations and generate supply that's in excess. But until one of those two things happen, this balance sheet is going to continue to get tighter. And I think as we look forward, you're going to be making planting decisions, right? So beans and corn have to go battle it out, and they've got to battle out for wheat acres in the north. They've got to some extent, they've got to compete for the Kansas wheat acre too, because you guys can kill the wheat and put it to corn or beans, right? You can double crop beans behind it. The market's got a lot of discovery to do in order to induce the right number of acres so that it can replenish supply. So that's what's going on, right? We've got price discovery happening. To me, the only takeaway that matters is that the trend here is down. And if I go back and put each of the previous months into here, you're just going to see that trend decreasing. Beans, extremely, extremely tight. Over here, these are just some what ifs, right? If we do have a yield hit in the spring, and we decrease our yield per acre, you can see we get extremely tight extremely fast. So the market's going to start to discount those types of possibilities moving forward. So now I'm going to address one other thing that I think is a really, really important topic right now. Lots of articles are being written and lots of opinions are out there about the size of the fund position. They are extremely long by traditional metrics. You've got the funds buying commodities like crazy. I think that's a bad analysis to just say they're as high, they own as much corn or as much beans as they did in 2012, and therefore they own too much, and so therefore we should go lower. I really disagree with that analysis because it's not 2012, it's 2021, and over the last decade, we have printed trillion upon trillions of dollars. And what that means is that the funds are bigger than they were. And so if a fund manager wants to have an equivalent exposure to 2012 in his portfolio, then he has to own a lot more corn. So I will make the argument to you that the fund world has a much smaller true position on than they did back in 2012. I think they've got a lot further to go. And another thing that's happening is that in the coming months, the CBOT and the CME are entertaining the idea of increasing position limits. So if you're a large fund today, you're limited to the number of contracts you can own. And the CBOT and CME are on the table right now is a recommendation to almost double what those trading limits are. And I firmly believe that the rationale, the policy behind that is twofold. One, it's to increase trading volume, and two, it's to accommodate the inflation, the larger funds, the larger dollar amounts that we are managing. So I think that there's a lot more room for these guys to keep buying, and I don't see what's going to cause them to change until something really gets nasty. All right, so those are the two main takeaways, right? Just because something's happened in the past doesn't mean it can't not happen again. And anytime we're looking at a market, we have to really make sure our minds are open to the reality that anything can happen. And just because it's been high before, it doesn't mean it can't go higher. And likewise, just because it's up today and yesterday doesn't mean we can't close limit down today. So anything can happen, and we've got to open our minds to that possibility. And I'm talking to myself there a little bit because probably the worst thing I could have done this morning, to be honest, is read everything that I read. Too many opinions coming at you from too many different directions makes you fuzzy. So let's try to make it really simple. All right, I've got corn up here, and before I get to this big monster gap here that appeared overnight, I will tell you that I went through the following indicators in detail early this morning. I went through the moving average convergence divergence, which is your MACD. I went through force index. I went through the RSI. I went through stochastics. I went through Bollinger Bands. I went through the cloud. I went through and I've gone through all of the TD indicators. And what I'm looking for are divergences. We've talked about those before. There are 0 divergences on the March corn chart. That tells you, what that tells me is that yes, we're way overbought. Yes, we are parabolic. Yes, we're probably moving too fast, but higher highs are more likely than not given the indicator setups. This is more indicative of a kind of a temporary top. When it does happen, we're going to pull back and then we'll move much higher. And I'm going to dive in here just a little bit to give you an idea of where I think we could go. Now, if you remember, last week we talked about the weekly chart, and I got to scroll this back out, so I'm sorry that this is going to get scrunched up on you. But here's where we are today. Get my crosshairs back on. Here's where we are today. Yes, we're up. We are not overbought on the weekly chart relation to history. This is the peak. I'm going to scrunch it up just a little bit more. So this goes back to 2009. Here's 2011. Here's 2010. Here's 2011. Here's 2012. This is really interesting because where we have traded to this morning is smack to the bottom of this gap on the weekly chart. Now, I've done a little bit of digging on this gap. This gap is the result of a switch in the continuation chart from one contract to the next. And so it's not that we closed a day at 684, which is the bottom of this bar, and opened the next day $2 lower. You can't do that because the limit is only 25 cents, right? So that doesn't make sense. So what happened here is we actually rolled one contract off and started a new one, and it created this huge gap. And if you look back here, it also gapped through this gap right in here, which created this whole price range, this whole thing from 2010, 11, 12, and 13. It created a giant island back here. And so this has been confusing to me for a really, really long time, but it's kind of been, out of mind, out of sight, out of mind for the last several years. Well, now it's front and center because as we've broken all these successive highs, now we've traded right to the bottom of it. The top of that line is 549. We hit 541.5 here in the overnight. If we trade into this gap, odds favor that gap actually ending up being closed all the way up at 684. I don't think we can do that in one fell swoop, but I do think that we have to keep our mind open to the reality that gaps tend to get filled. All right. Now, having said that, let's go back to our daily chart, because I think I just pointed out and said we'd get back to this here in a little bit, is that this morning we've got a giant gap on the daily chart. This is see, the top of this gap is 517.25. The bottom here is today's low at 522.25. So we've got a 5-cent gap here from yesterday's close, which we locked limit, and now we've got a 5-cent gap. Remember, there's only three real types of gaps. You have breakaway gaps, which would be this right here. You have continuation gaps, and you have exhaustion gaps. I'm going to go ahead and rule out that that's a breakaway gap. That happened back here. We don't have any intermediate gaps into here, so we could be dealing with a continuation gap, which means that we've reached the halfway point from the origin of the rally back here at 330 all the way up to yesterday's close at 517. So you can double that move from here using that analysis. Now, I don't think that that's what we have. I think we have more of an exhaustion type gap here. And the reason is this force index reading. This force index reading has gone parabolic, and that would be more indicative of an exhaustion spike than it would be a measuring gap. But the jury's out. That gap needs to get filled, and the longer it stays open, the more likely it is that it's a measuring gap. And so again, we got to open our minds that anything is possible. And if South America comes in under where the USDA says it is, right, and news crop supply gets tighter than it was, or China buys more than we think they're going to buy, or we don't plant acres like we think we're going to plant, or we get into a weather problem, those are all wild cards that could flip in favor of the bulls here and prevent this from getting filled. And remember the bullish argument for food inflation and fund availability and length. Those factors can push us higher. So I don't want anyone to run out and say, hey, the Ag Astro people think that corn's going to $10. I don't want anyone to run out and say that, but I don't want to take a significant higher move off the table here either, because the market's got to wrestle with this gap. All right, that's enough on corn. Last thing I'm going to say is you got three choices. You can buy it, you can sell it, or you can choose to do nothing. Those are your three choices to make as a trader. Given today's action, this morning's action, my decision is to do nothing. I'm just going to sit and let this thing play out. And if we work higher, I'm probably going to be more inclined to start trimming length and reducing some exposure. If we reverse and close this gap, we're going to scratch our heads a little bit. If we trade back down, all the way back down to $5, I probably think that's a spot to add more length and to buy a retracement. So I really don't have any interest in being a seller today until we get more clarity on what this gap is going to do. You know, we could fill it and run back higher. We could just keep marching higher. We could implode and come limit down today. The limit today on corn is 40 cents, and we could use every bit of it. So I don't know what's going to happen. So that's why I'm going to just decide to hold and just let things play out, and we'll live and die by that decision, and I'm perfectly fine with that. All right, let's look at March soybeans. Similar to corn, except for they're a little bit more advanced, right? They've been leading the charge all along, and so far this morning, we are working a hook reversal after that big close yesterday. So beans could be looking for a break here. But I will tell you, I went through the same indicators on beans: MACD, force index, RSI, stochastics, Bollinger Bands, and sequential indicators. None of them are showing divergences. In fact, if you look at the weekly chart on beans, it's actually not even close to being overbought basis all those other indicators. Beans have room to continue running, potentially even all the way up to 1538 before they meet any chart resistance. So it'll be interesting to see what the market does here. My best guess is that we've got a little bit more time and probably another push to the upside before we run into resistance. And then we're going to set the stage for an acreage war. So we're going to be buying a significant break if and when that comes. All right, wheat, and I'm almost out of town. Wheat is the black sheep of the family, and I think it's interesting because it does have some divergences on at least the potential for divergences on the MACD, force index, but not the RSI, not the stochastics, not the sequential indicators. And I say potential because they're not confirmed at all. Wheat broke out over the last couple of weeks. It broke this resistance level. It tested it. It's now support. Then we broke the old highs. By all accounts, wheat has started a new leg higher, and it projects probably to 675 to 690 before it should run into any more resistance. But I don't, with the potential of divergences on it, I don't think that wheat is going to be able to maintain strength if corn and beans both break. I think wheat's going to go with it. And I want to show you this last chart here. This is the Kansas City wheat corn spread. And this is still showing the nearby, well, no, this is March. So our spread is 93 cents. And if you can see what's happening here, this spread is in a downtrend, meaning that wheat is getting closer to the price of corn. And it's actually threatening to insert itself into the feed rations because, well, it might be because corn is getting tighter than maybe we think it is. So we want to keep an eye on this. It's kind of at some critical support levels. And if these break, then we could open up that spread to a much lower trade, which would make sense. If we've got to ration corn, that means we got to feed something else because the animals got to eat, and wheat's probably the grain with the most supply. So it actually makes sense, and it should ultimately be bullish for wheat and support higher prices. So wheat, I think, is the most difficult one to trade here because it's being drug around, and it's being influenced by other things. But the best reading today is we have a breakout, and wheat should be working higher, and a trade back below 615, 610, a close back below that level probably invalidates that argument. It tells us that we might have topped. So we're going to keep an eye on that and do everything we can to monitor that for everybody. So that is what I've got for you this week. Remember, you can buy, you can sell, or you can stand aside. We're standing aside today and just going to let things play out. If we're up 40 cents, maybe we'll change our mind and start selling some stuff. But I think this market's telling you, give it room, give it space, let it digest, let it go through its discovery before we make any rash decisions. And with that, the traditional disclaimer: there is significant risk in trading futures and options. You've got to trade to your own financial ability and be aware of the risks that you're taking. The market doesn't have to do what I say it's going to do. It's going to do its own thing, and all we can do is report what it does. So with that, I hope you guys have a great week, and we will talk to you next week.